welcome to our YouTube channel. I'm Shruti and I'm here with my enthusiast team members Meesha and Sujata. Today we are diving into an exciting and crucial topic in the world of finance, the futures and forward contract. Now, I know financial jargons can be a bit intimidating, but worry not. We are here to break it down for you in a way that not only easy to understand but also interesting and relevant. So whether you're a financial enthusiast, a college student, or someone who are just curious about the financial learning, you are in the right place. Let's begin the video with the introduction to derivatives. Now, alright, imagine you're making a pizza. A dough is like a basic financial thing. Let's say stocks and commodities. Now, derivatives are like an extra toppings. They don't exist on their own, but they make your pizza more interesting. So, derivatives are financial things whose value depends on something else like stocks, interest rates, or even the weather. So, they're not the main ingredients. They're like a flavor booster.
So there are majorly two types of derivatives, forward and future contract. Let's dig into the definitions. Forward contract. A forward contract is a private agreement between two parties to buy or sell an asset at a specified future date for a price agreed upon today. So, what is a future contract? A future contract is the exchange traded of a forward contract. It obligates the buyer to purchase or the seller to sell an asset at a predetermined price on a specified future date.
Alright, let's break down forward contract in simple terms. Think of a forward contract like a making deal with your friend to buy a video game. But next month, it will be at a fixed price, no matter what the actual market price fluctuates. So, let's understand it with an example. Let's say you want to buy a rare video game from your friend, but the price keeps changing. You worry it might get too expensive by the next month. So you both decided to fix a price of a $50, okay? Now, no matter what, the game begins super popular and the price goes above $70. The next month, you still get it for the $50, which was about the forward contract. If the price drops by $40, your friend is still obligated to sell you at $50. So it's like having a price shield for your favorite game. Remember, forward contracts are like a personal agreements. They are handy for managing uncertainties and make sure that you get what you want at what price.
Futures contract. Let's understand the concept through features. First, standardization. Future contracts have standardized terms for the underlying asset, quantity and expiration date. Second, underlying asset. Futures can be based on commodities, for example oil, financial instruments, for example stock, indices or other assets. Third, contract size. Each contract represents a specific quantity of the underlying asset. For example, suppose an oil producer wants to sell oil but fears that the oil prices may fall in the future. To ensure the oil producer gets a predetermined price and not incur a loss, a future contract can be used. Types of future contracts. There are majorly 4 types of future contracts. First, equity futures, currency futures, commodity futures, and index futures. Now let's have a look at the evolution of future contract. Developed from forward contracts to ensure standardized terms, mitigate counterparty risk, and provide liquidity. There are different ways to settle future contracts. First is physical delivery of underlying asset, and second is the cash settlement. Let's have a significance or know the importance of future contract. First is risk management, hedging against price fluctuations, price discovery, efficient reflection of market expectations. Third is capital efficiency, leverage for investments, and fourth is market efficiency, increased liquidity and price transparency.
So let's know the differences between future and forward contracts on different bases. Standardization. Futures are standardized contracts traded on exchanges, while forwards are customizable private agreements. Market accessibility. Futures are traded on organized exchanges, providing liquidity, whereas forwards are traded directly between parties. Counterparty risk. There are higher counterparty risk in forwards due to lack of exchange intermediaries, whereas future have a clearing house to mitigate the risk. So what are the different bases? Margin requirement. Forward contracts, typically no initial margin is required, but there is a higher counterparty risk. In future contracts, exchanges require an initial margin to cover potential losses. This ensures both parties meet their obligations. Market to market. Forward contracts, no daily marketing to market. Profits and losses are settled at the contract's maturity, whereas future contracts daily marketing to market. The contract's value is adjusted daily based on the market prices. Gains or losses are settled daily.